Talked a little bit earlier about futures and cash price relationships. We're going to delve a little bit more into that. Again, as I mentioned, soybeans are primarily based upon futures prices. So when you hear a price quoted by a buyer or an elevator, it is typically going to be a value plus or minus a particular futures contract price. There are multiple futures contracts for each year for soybean. When we look at them, the November contract in any year is what we're going to refer to, or what you might refer to as the new crop contract. What we mean by that, that is the soybean futures contract that happens after the majority of our soybeans are harvested here in the United States. So the November contract is going to be the new crop contract that we're going to talk about, or that is often referred to when you listen to market analysts and market projections. As I mentioned earlier, futures prices are localized by basis, and basis is simply the difference between the futures and the cash prices. Factors that influence basis levels, lots of them. Location, transportation costs, storage costs, local supply and demand conditions, and other transaction costs. And what this simply means is that theoretically we would expect basis levels to be lower the further away you get from demand sources. So here in Louisiana, the export market is a pretty substantial market. So as you get further down the Mississippi River and down to the Gulf, elevators or buyers, the closer you get to the Gulf and to that export market, basis levels tend to be stronger. As you move up in the northern part of the state, those basis levels tend on average to be a little bit lower, because theoretically what we have to do is buy them up in North Louisiana, transport them the rest of the way down the Mississippi River and out to that export market. So the difference between the basis level in North Louisiana and South Louisiana theoretically would be what it would cost to transport and all the transactions related to moving those beans from North Louisiana down to South Louisiana and then on to the export market. This is the soybean futures contract. The soybeans futures are traded at the Chicago Board of Trade or Chicago Mercantile Exchange. These are traded. They are 5,000 bushel lots or contracts. So every contract of soybeans that you hear marketed represent 5,000 bushels. And as you can see here, the number 2 yellow is the basis or the standard for which these soybeans are sold. A number 1 yellow, based on this contract, would have a 6 cents per bushel premium, and number 3 yellow would have a 6 cents per bushel discount. So you can see here, the yellow, number 2, is the standard, and anything off of that, either above or below, would represent a premium or a discount. 5,000 bushels per contract. You can see here there are 6 or 7 contracts per year, each with a different delivery month. So we have January, March, May, July, August, September, and November as being delivery months associated with these futures contracts. Typically, delivery is never made. People buy and sell these futures contracts simply on paper. They'll buy them now and then resell them to get out of their obligations. But what they do is they do help direct and project where we're going to see prices move in the future. So right now, if we look at November 2014 futures contract prices, that would give us an indication of where the market, at least at this point in time, expects soybean prices to be next November, or in November 2014. When you look at soybean futures, they are limited in terms of how much they can go up or down in one day. Most of the commodities have these limits. In the case of soybeans, 70 cents per bushel is the limit. So if soybeans, for whatever reason, prices start to move up, futures prices start to move up in a day, once it hits 70 cents, the market is shut down for the day. Likewise, if soybean futures prices start to move down in a day and hit 70 cents, the market will be shut down once it hits that level. Again, this is a kind of a risk management strategy by the Board of Trade. It allows or limits how much a holder or a seller of a futures contract could lose in a particular day. As I mentioned, there are several different contracts, and this is just a snapshot of soybean futures contract prices. As you can see here, that not only do we have them traded for the different months within the year, but we trade those contracts several years out in advance. From this snapshot, you can see here November 14, 2014, soybean futures are trading at 11.64. So what does this mean? It means that at this point in time, on this day, the market believes that once we get to November 2014, we're going to be looking at soybean prices roughly around $11.64 per bushel. Again, you can project out to 2015 and 2016. Typically, futures are sold 2 to 3 years out in advance. And again, you have all these contract months that you can buy and sell. And again, all of them provide some kind of level of price projection for the market. This may be a little bit tougher slide to see, but this is Louisiana basis levels. We talked about localizing those futures prices. That November 2014 futures price that we just saw, 11.64, doesn't necessarily mean that we expect to see that price here in Louisiana. We have to localize it to Louisiana situation. And we do that by taking that futures price and adjusting it by an historical basis level. And you can see here, basis levels are pretty variable throughout the year. They tend to get stronger as we move to harvest, because what happens is that there's a little bit of a risk premium prior to harvest. We don't know exactly what the size of the crop is going to be. As we get closer to harvest, we have a little bit better understanding of where prices need to be, where futures prices and cash price start to kind of converge to each other, and we start to see a little bit historically of an appreciation or improvement in basis levels as we get to harvest. That will happen for about a month or so, and as we get away from harvest, we tend to see basis levels start to decline a little bit. The one thing that this shows, and really when you look at the three lines that we have here, these are for different time periods over the last 15 to 20 years. What you see here is that all three lines follow fairly similar type of shape. So we see the same time each and every year that we start to see basis levels improve. But what you also see is that basis levels have changed quite substantially over the last 15 to 20 years. From 1996 through 1999, the average Louisiana basis was about 14 cents above futures contract prices in Louisiana. When you get to 2000 to 2005, that fell to about 6 cents above. Now keep in mind, we talk about on average across Louisiana, and as I mentioned earlier, North Louisiana versus South Louisiana is going to have some difference, but when you average all those together, about 6 cents from 2000 to 2005. And then when you look at 2006 to 2010, it went from 6 cents above futures to 24 cents below futures on average. And you say, well, what happened there? Well, that's about the same time that we saw the tremendous increase in demand for soybeans and feed grains. We saw futures prices go through the roof, and as futures prices outpaced where supply and demand conditions probably suggested they needed to be, what happens is that once futures prices go beyond where supply and demand fundamentals expect them to go, buyers start to adjust that back downward by affecting basis. And what happened was, when we saw those huge futures prices, we got those futures prices back in line with what supply and demand conditions said by reducing those basis levels. They have since come up. In 2013, we're looking at basis levels that are a lot more in line of what we saw during the late 90s. We're looking at supply and demand, basis levels that are primarily in the 20 to 30 cents above futures prices at this point in time. And that is primarily a function of the supply and demand dynamics. If you remember back, ending stocks are about 120 to 150 million bushel carryout level. That is historically a very, very tight stock situation, meaning that we've got a lot of demand built up and we've got only limited supplies of soybeans to meet that demand. And that there's a chance when we get to that kind of situation that we would run out of soybeans if we don't start to ration them, and we ration them through prices. So what was happening here, particularly over the last couple of years, is that very, very tight stock situation has really improved the basis levels that we've seen and got them much more back in line to what we would have historically suggested they would have been back in the late 90s and really early 2000s.